Modern technique, as the name itself suggests, it is of recent origin. Capital employed refers to the investment which is being made by the management and what is the return we are earning. Why should we prepare the final accounts of companies? In order to know whether the company is in a profit or loss. What do you mean by short-term obligations? It is nothing but the current liabilities which are in the company. Hello everyone, I am Purnima, faculty in the Department of Commerce, Vidhyaashram Pre-University College, Temple of Excellence. Now, in this session, this will be the last session on the chapter Controlling. In session 3 of Controlling, I will be discussing about the modern techniques of controlling, and we will be just seeing what is the meaning of modern technique and what are the various modern techniques used for controlling in an organization. Let us just look into what is the meaning of modern techniques. So here we have the traditional and modern techniques. So in my previous session, I have explained about the traditional techniques. Now, let us understand what is the meaning of the word modern techniques. So, modern techniques of controlling are those which are of recent origin and are comparatively new in management literature. So, we should understand that modern technique, as the name itself suggests, it is of recent origin. So, these are comparatively new for management literature, or for the management, subject of management, there are certain techniques which are being used nowadays, and these techniques we call it as modern techniques. Now, in the modern techniques, we have 6 techniques. The first modern technique is return on investment. Now, let us understand the meaning of the word return on investment. Return on investment can be used to measure the overall performance of an organization or of its individual departments or divisions. It can be calculated as under. So, return on investment equals net income before interest and tax divided by capital employed. So, as the name itself suggests, the return on investment refers to what is the return which the investment is earning. So, here capital employed refers to the investment which is being made by the management and what is the return we are earning. So, what is the net income which the company is earning for the amount which it has invested. So, this will be calculated on the basis of individual departments or divisions. So, for each department, we are calculating the return on investment. Suppose it is the purchase department. Now, what is the investment we have done for the purchase department and what is the return we are getting from the purchase department? The same way for the sales department, marketing department, etc. So, when we calculate the return on investment for each department, we will be able to analyze whether the department is working efficiently or not. So, this is one of the most important and the best modern technique of controlling. Now, we'll again look into what is the return on investment. So, net income before or after tax may be used for making comparisons. Total investment includes both working as well as fixed capital invested in the business. So, according to this technique, return on investment can be increased either by increasing the sales volume proportionately more than total investment or by reducing the total investment without having any reductions in sales volume. So, the net income before or after tax may be used for making the comparisons. Now, when we calculate ROI for all the departments, then we can have a comparison on which department is giving the best return on investment. Now, the total investment. So, here we have to just ascertain what is the investment. So, how do we ascertain the investment? It is done by adding both the fixed capital and the working capital. And then the net income which is earned by that particular department is calculated, and then we can calculate the return on investment. Now, according to this technique, the return on investment can be increased either by increasing the sales volume proportionately. Now, when we increase the sales volume proportionately, then we can have a better return on investment. Or another option is you just reduce the total investment so that you can get a better return on investment. So, these are the different ways in which we can have a better return on investment. So, in order to get a better return on investment, either we should increase our sales volume proportionately or we can decrease the investment proportionately. Then, the next type of controlling in the modern technique is ratio analysis. Now, what is this ratio analysis? Ratio analysis refers to analysis of financial statements through computation of ratios. Now, ratio analysis means, so we are analyzing the financial statements. As we all know, at the end of the year, we calculate the final accounts for all the organizations. Usually, the financial year ends on 31st March, and on 31st March itself, we prepare the final accounts of companies. Now, why should we prepare the final accounts of companies? In order to know whether the company is in a profit or loss. So, after calculating the net profit of the company, we will be paying the necessary tax to the government. Now, these financial statements as such, they don't infer anything. Suppose we say that there is a profit of 20 crores to company A, it does not mean anything. Then, suppose we have a comparison. So, company A is doing business and it has a profit of 20 crores. Now, company B is also in the same business, but it is having a profit of 25 crores. When we have comparison between two companies, we can come to the conclusion that company B is doing better than company A. Now, these ratios are designed to see that we have a better comparison, or whatever money we have invested, we can compare it with proportionately with the income which is generated from that investment. So, all these ratios are calculated to interpret a better meaning of the financial statements. Now, let us look into what are the ratios to be calculated here. Now, the first ratio is the liquidity ratio. This liquidity ratio is calculated to know the short-term solvency of the company. Now, what do we mean by short-term solvency? Through the liquidity ratios, we will be able to know whether the company is in a position to pay off all its short-term obligations. Now, what do you mean by short-term obligations? It is nothing but the current liabilities which are in the company. So, all those current liabilities which are to be repaid within 1 year. So, all these current liabilities, how efficiently the company is able to repay its current liabilities, that we will be able to know when we calculate the liquidity ratios. Now, in liquidity ratios, we can have two ratios, that is current ratio and second one is quick ratio. So, current ratio and quick ratios will enable us to know the short-term liquidity position of the company. Now, the second ratio is the solvency ratio. With the help of this solvency ratio, we will be able to analyze whether the company is in a position to pay off its long-term liabilities. Now, the next type of ratio is profitability ratio. Now, what do we mean by profitability ratio? These ratios are calculated to know the profitability position of the organization. We will be studying the profits in relation to the sales volume. So, what is the volume of sales the company has done and what is the proportion of profit the company has earned? All this we will be able to know through this profitability ratio. In the fourth one, that is the turnover ratio, we will be able to analyze how efficiently the company's resources have been utilized and what is the return turnover got from these resources. So, all these ratios help us to understand what is the investment made by the company and what is the return the company is earning. So, in this way, we can see that there is a form of controlling on the investment. We can also see that there is a sort of control on the profits of the organization. The third technique of controlling is responsibility accounting. Now, let us see what is the meaning of this responsibility accounting. Responsibility accounting is a system of accounting in which different sections, divisions, and departments of an organization are set up as responsibility centers. The head of the center is responsible for achieving the target set for his center. Now, let us understand what is the meaning of responsibility accounting. So, it is a system of accounting where different sections, divisions, and departments are set up as responsibility centers. Now, you consider one particular department as a responsibility center and the head of that department will be the responsible for that particular center. Now, let us look into what are the different types of responsibility centers. Now, in this, the first one is the cost center. A cost or expense center is a segment of the organization in which managers are held responsible for the cost incurred in the center but not for the revenues. So, a cost or expense center is a segment of an organization. It is a part of the organization in which the managers are held responsible for the costs incurred in that particular center but not for the revenues. For example, in a manufacturing department, the production department will be considered as the cost center. Why production department is considered as the cost center? It will have more cost. That is, the cost of raw materials will be included in the production center. Now, the next type of responsibility center is revenue center. A revenue center is a segment of an organization which is primarily responsible for generating revenue. For example, marketing department of an organization may be classified as a revenue center. So, in this responsibility accounting, we are demarcating each department as one responsibility center. Now, cost center, we have the production department, and for the revenue center, we have the marketing department. Now, why we consider marketing department as a revenue center? Because all the revenue which is coming to the organization, it is through the sales of the products. So, whenever we sell, how well we sell the products, that same way the company will be earning revenue. So, this marketing department as such will be considered as the revenue center. So, it is responsible for all the incomes of the organization. Then, the third type of responsibility center is the profit center. Now, what is a profit center? A profit center is a segment of an organization whose manager is responsible for both revenues and costs. For example, repair and maintenance department of an organization may be treated as a profit center if it is allowed to bill other production departments for the services provided to them. Now, a profit center is that part of the organization which is responsible for both incomes and expenditure. Now, if you can take the example of the repair and maintenance department. So, whenever we have a manufacturing department, it will have lot of machinery in the organization. Now, we need to have a repair and service department which will be always there to service the machinery of the organization. Now, we call this repair and maintenance center as a profit center. Why do we call it as a profit center? Because if it is allowed to bill other production departments for the services given to them. So, when the repair department goes and repairs the machinery of the production department, it will send a bill to the production department about the repair charges. Now, this sort of a system existing in an organization, we call it as the profit center. Now, the fourth type of responsibility accounting is investment center. An investment center is responsible not only for profits but also for investments made in the center in the form of assets. The investment made in each center is separately ascertained and return on investment is used as a basis for judging the performance of the center. Now, the investment center is a center which is responsible not only for profits but also it is responsible for the investments made in the form of assets. Now, whenever we are making investments in each center, we will just analyze or calculate the return on investment and then we judge the performance of each center. So, these are the four types of responsibility centers which are existing in all organizations. Now, the fourth technique of controlling in modern technique is management audit. Now, what do we mean by management audit? It refers to the systematic appraisal of the overall performance of management of an organization. So, it refers to systematic appraisal of overall performance of the management of the organization. Now, we should understand what is the meaning of the word appraisal. Appraisal is nothing but we are measuring the performance of each department. So, whether it is the top management, middle management or the lowest levels of management, how the management levels are performing in the organization. So, you are assessing or measuring the efficiency of all the persons in the top management, middle management and the lower levels of management. The purpose is to review the efficiency and effectiveness of management and to improve its performance in the future periods. Now, through management audit, we will be able to know which of the management, whether it is middle management, top management or the lowest levels of management, who is performing in the most effective and efficient manner. It is also helpful in identifying the deficiencies in the performance of management functions. So, with the help of management audit, we will be able to ascertain the deficiencies, where there are deficiencies in the performance of management and what level of management is doing well. So, all these things we will be able to measure with the help of management audit. Now, management audit may be defined as evaluation of the functioning, performance and effectiveness of management of an organization. Now, as I had explained earlier, so we are having an evaluation of the functioning of management, how well the management is functioning and what is the performance and how effective the management is. So, all this will be assessed through management audit. Then, let us look into what are the advantages of having management audit. The main advantages of management audit are, it helps to locate present and potential deficiencies in the performance of management functions. So when we are just evaluating the performance of the management, we will be able to see what are the deficiencies, where the deficiency lies, or we will be able to know which part of the management is working effectively and which part of the management is not working so very effectively. Then the second advantage of management audit is it helps to improve the control system of an organization by continuously monitoring the performance of management. So, through the management audit, we can have a system of control in the organization. So, when we are continuously assessing the effectiveness of management, it will act as a control on the performance of management functions. Then the next advantage of management audit is it improves coordination in the functioning of various departments so that they work together effectively towards the achievement of organizational objectives. So as you all know, coordination is a part of management. So in addition to the functions of management, the management should ensure that there is proper coordination between all the departments of the organization. So with the help of this management audit, we can ensure that there is proper coordination in the functioning of various departments of the organization, and through coordination we can ensure that organizational goals are achieved. Then the last advantage of management audit is it ensures updating of existing managerial policies and strategies in the light of environmental changes. Now, with the help of management audit, we can see that there is constant updating of managerial policies and strategies in the light of environmental changes. So, according to the environmental changes, we can always have a change in the policies of the organization. So, in this way, the organization will adjust itself or adapt itself to the changes in the business environment. Then, the next type of modern technique is PERT and CPM. If you can see this diagram shows the PERT and CPM technique. Now let us understand what is the meaning of the word PERT. PERT means Program Evaluation and Review Technique. Program Evaluation and Review Technique. And CPM means Critical Path Method. They are important network techniques useful in planning and controlling. Now, these are two powerful techniques of management through which we will be able to ensure that there is proper controlling system in the organization. Now, these techniques are especially useful for planning, scheduling, and implementing time-bound projects involving performance of a variety of complex, diverse and interrelated activities. Now, with the help of PERT and CPM, we will be able to have a proper plan. So, with the help of this PERT and CPM technique, we can plan, schedule and implement projects which are very complex and diverse, and there are so many interrelated activities. Now, what are the various steps involved in PERT and CPM? The first step is the project is divided into number of clearly identified activities which are then arranged in a logical sequence. So, the project is divided into number of clearly identifiable activities. Now, when you have to plan for a project, the first step is you have to make a note of what are the activities involved in the project, and then you arrange them in a logical sequence. Now, the second step is a network diagram is prepared to show the sequence of activities, the starting point and terminating point of the project. Now, in the second step, a network diagram is prepared. Now, how do we prepare the network diagram? So, where is the starting point of the activity and the ending point of the activity, and in between we have a logical sequence of activities. Now, the third step in PERT and CPM is the time estimates are prepared for each activity. So, for each activity you provide a time frame within which that activity has to be completed. Now, the fourth step is the longest path in the network is considered as the critical path. So, there are various ways of doing a project. Now, these various ways are shown in a network diagram, and then the longest path will be considered as the most critical path of the project, and the plan is modified so that execution and timely completion of the project is under control. Now, we have different ways of just seeing how we can do the project, and then the plan can be modified so that we can complete the project on time and in the best use of resources. So, we can see that there is proper execution of the project and also the project gets completed on time. Then, the last technique of controlling, or the modern technique of controlling, is management information system. So, we can also call it as MIS. Now, what is this MIS? It is a computer-based information system that provides information and support for effective managerial decision making. So, as you all know, the top management is always involved in making the plans for the organization, and to plan for the organization, we need a proper system of information. Now, who gives us this information? So, this information can be got through this management information system. So, it is a computer-based information system. So, with the help of computers, it will provide us all the information which are necessary for managerial decision making. So, a decision maker requires up-to-date, accurate and timely information. So, whenever a manager has to take decisions, it will be always based on facts and based on the data which has been supplied to him. So, it should always be up-to-date, accurate and timely information. So, this sort of information is provided by this management information system. Now, just let us see how this MIS will help in the controlling function. The MIS also serves as an important control technique. It provides data and information to the managers at the right time so that appropriate corrective action may be taken in case of deviations from standards. So, this MIS system will provide the managers with proper information. If there is any deviation in the activities relating to any particular department, a MIS will alert the manager and it says that the manager takes corrective action at the right time so that there will not be any deviation from the plans. So, in this way, we can ensure that MIS is helping in controlling function. Now, let us look into what are the advantages of having MIS in the organization, or how helpful this management information system is. Now, it offers the following advantages to the managers. Now, what are the advantages? It facilitates collection, management and dissemination of information at different levels of management across different departments of the organization. So, with the help of the MIS, we can always collect information relating to management of information of the various levels of organization and of all the departments. So there may be so many departments in the organization at various levels of organization, and information relating to each department at each level will be collected and classified through this management information system. Now, the second advantage of MIS is it supports planning, decision making and controlling at all levels. So, with MIS, it will help in planning, decision making and controlling at all levels. Then, the next advantage of MIS is it improves the quality of information with which a manager works. So, because this MIS is providing up-to-date information to the manager and timely and accurate information, it will help the manager in taking proper decisions. Then, next one is it ensures cost effectiveness in managing information. So, when we set up a MIS in the organization, it will be a cost-effective system of control. So, whatever is being done in each department is automatically recorded, and then it will be very cheaper for the organization because we can always collect first-hand information easily. Then, fifth one is it reduces information overload on the managers as only relevant information is provided to them. So, with the help of this MIS, it will help the manager because only those aspects of the organization which need immediate attention will be given to the managers, and those which are irrelevant will not be given. So, in this way, we can control information overload in the organization. So, these are the various modern techniques of controlling through which the management will function in an organization. I hope you have all understood what are the various modern techniques of controlling in an organization. Thank you.